I'm about to show you something extremely powerful of how we can interpret where the market is likely to go and how we can understand directional bias. If we are able to understand where the market is likely to go, then we are able to find better quality setups and therefore make more money, right? In this video, I'm going to show you exactly how to do that. And at the end of this video, I'm going to show you an execution that I actually took on the euro dollar using everything that I'm about to teach you in this video. So stick around, it will definitely be worth it. Anyway, let's dive straight into what we can see here. Here we have the euro dollar on a daily time frame. I'm going back as far as 2023 and I'm going to walk you through all of the price action to a 5-minute time frame that I recently executed on. Now, since price is fractal, anything that we see on the higher time frame is applicable to the lower time frames. And I'm going to show you a very specific signatures in price that repeat over and over. So bear with me because this will make a lot more sense later on. As we now know, we have an established dealing range here in front of us with a dealing range high and a dealing range low. And for the sake of saving time here, we are in a higher time frame buy program where we are anticipating higher prices. There is a pool of liquidity to the left and or an inefficiency above the market. Inside of this buy program, we are anticipating a type 1 continuation dealing range to form. Now, this will form when we raid sell side liquidity below an old swing low and buy side liquidity above an old swing high. This now creates a new dealing range from our dealing range high, or our DRH, and the dealing range low, or our DRL. Now that we have established our new dealing range, we can grade this dealing range with our DRT levels. We have the 75 DRT level, which is 75% of this dealing range, the 50 DRT level, the 25 DRT level, and then obviously the dealing range low and the dealing range high. Now again, this is going to be a type 1 dealing range since we are expecting higher prices. One of the ways to identify a type 1 dealing range is that it will be nested inside of a higher time frame type 2 dealing range, and I'm going to get onto that in a second. When we have a type 1 dealing range, we anticipate price to drop lower below 50 DRT, which is our equilibrium level, and into a discount market. Now, note what we have here inside of our extreme discount. This down close candle becomes a high probability bullish order block. Note how price is consolidating inside of that order block. Now, all of this consolidation here inside of an extreme discount is indicative of smart money accumulating long positions to offload those to willing buyers above a dealing range high. Now, a clue that we can use over here is if we look to a correlated asset pair with the euro dollar, such as dollar index, for example. What we want to identify is a cracking correlation, and what I like to use is the lowest down close or open inside of a swing. This is going to be our rejection block. Now, the classic way of looking for SMT divergence is using the highs, but with dealing range theory, we use the bodies. And as you can see here, where we have our rejection block on dollar index, which is the equivalent rejection block here on the euro dollar, we can clearly see that the bodies here are failing to close below that rejection block. On the dollar index, we can see here that the bodies are closing above that rejection block. The fact that the euro dollar does not want to close below its rejection block inside of that dealing range low, and it's accumulating inside of an extreme discount at an order block, whereas we're seeing the dollar index run and close above its rejection block. This shows professional accumulation of longs on euro dollar, and this is something known as a rejection block SMT divergence. If this was a market moving in sync, then we would also expect the euro dollar to close back below its rejection block. In this case, it hasn't. Now, with this behind us, we can anticipate price to continue higher and target the type 1 dealing range high. What we now notice here is another really nice algorithmic signature in price. If we look at the low on this candle and the high on this candle, which is the area between the 25 DRT level and the mean threshold of the order block, we can see this inversion fair value gap, like so. Note the bodies over here, they're respecting the discount low of that inversion fair value gap. And then we see price turn around here and run higher. Notice how it closes above that 50 DRT level. Again, this is a very strong algorithmic signature in price that indicates that the market wants to spool higher. Notice what we have at this 50 DRT level. We have another buy-side imbalance. Again, note the bodies over here. They're failing to close deeper into that buy-side imbalance and are respecting the 50 DRT level. So if you miss this entry down here, then you get a second chance at that 50 DRT level. Above 50 DRT, ideally we do not want to enter any new long positions, unless we obviously go down to a lower time frame and we can refine our stops there. In this case, we have seen price run into an extreme premium and we've seen the candles close here. Once that occurs, this fair value gap down here we anticipate to be left open. This is known as a breakaway gap because price is breaking away from all of this consolidation over here. So where smart money were accumulating long positions, the algorithm now is going to reprice higher to the stops above the dealing range high. Note these up close candles over here, how they're all supporting price all the way until we get above the dealing range high. This is how we can anticipate and track order flow and continuously get feedback whether we're on the right side of the market. Now, after we've raided the dealing range high, which remember is going to be a major buy-side liquidity pool, we form a new dealing range high. So now the next major liquidity pool rests above that dealing range high, and again we still have our major sell-side liquidity pool resting below the dealing range low. Now that we have our new dealing range, we can again grade this dealing range so that we can find our DRT levels. Let's just scrub this over to the right. Over here you can see that we have now a type 1 dealing range, but we also have equal highs over here. So again, if we didn't even know that price is going to continue higher, we still have equal highs above the market where we have a likely draw on liquidity, and this can also be classed as a type 2 dealing range inside of a type 1 dealing range. Now we still have buy side targets above the market, and until price proves to us that is going to switch gears, we continue with our higher time frame bias. Now again, we anticipate price to drop back below into a discount market below the 50 DRT level, and that's exactly what we see here. Note how we tap that 25 DRT level. If you look left, what else can you see at that price point? You see how we have our inversion fair value gap? Again, this nests at that 25 DRT level, and price respects the discount low here. And also note the bodies. They're failing to close deeper into that inversion fair value gap. This shows that price is in a hurry to reprice higher, and again is a fantastic little algorithmic signature that we want to look for in price. Again, this gives us feedback, right? The price wants to go higher, therefore we want to see the bodies where the bulk of the volume is contained show us that it isn't having any willingness to go lower. And of course then we can see how price runs higher and raids the stops below the dealing range high. So all of those accumulated longs here and here are being offset to the buy stops above these equal highs. Now, note what happens here. Again, for the sake of time, has breached and completed our higher time frame objective. We then see it turn around here and close back inside of the dealing range. Before this happens, we can see it forms a balanced price range. So this again is significant and suggests that price is now likely to switch gears and run lower. Where is it likely to target next? Well, we have these relative equal lows, and this low down here is in close proximity to these lows, and it's lower than the lows to the right. This gives us a nice low resistance liquidity run signature. And this is exactly what we want to look for inside of a type 2 dealing range. So since now we have a type 2 dealing range, we have a clear draw on liquidity below the market. And this is what we see eventually happen, is price turns around, drops lower. Note the reaction we have here at that 75 DRT level, and then it continues lower for the major sell side liquidity pool below the dealing range low. Let's just scrub this to the left again, and we can see now that we have a new dealing range high and we have a new dealing range low. You can see this dealing range low here has raided that previous dealing range low. And this has occurred after completing a higher time frame buy program. Now, when this happens after completing a higher time frame buy program and sweeping below a previous dealing range low, this gives us something that we can call a type 3 dealing range. Now, type 3 dealing ranges are notoriously difficult to trade, and this is generally where we will see consolidation for larger amounts of time. And this is exactly what we've seen here a few years ago on the euro dollar. When we have these types of dealing ranges, with the conditions that I just outlined previously, we anticipate the market to gyrate between an extreme premium and an extreme discount. And again, I mentioned this all last year inside of my 2024 Forex mentorship. But let's get a little bit deeper here and use type 1, type 2 dealing ranges inside of a type 3 dealing range, utilizing extreme discount and extreme premium ranges to see how we can flesh out high probability setups even inside of a consolidated market. Let me just dim out these levels here, and I want to draw your attention to this swing high here that raided buy side liquidity above a previous swing high, and then this swing low here that raided all of that sell side liquidity to the left. This gives us a new minor dealing range inside of our parent type 3 dealing range. Notice how we see price run higher above the 50 DRT level and into an inversion fair value gap to the left. Note the bodies over here. They're failing to close above that inversion fair value gap. And this again is exactly what we want to see in price action if we anticipate lower prices. Where do we anticipate it to drop to? Well, the minor dealing range low and that previous major sell side liquidity below that dealing range low. You can see how as price runs lower, we're seeing these inefficiencies reprice to until we see price drop below that old dealing range low, and then we start seeing that whole accumulation again inside of that lower quadrant. There is also now this dealing range high that has raided again a small pool of buy side liquidity to the left, and now we have a new dealing range low that raided the previous dealing range low. We can now grade this range, and more importantly, I'm interested in that 25 DRT level. We can see again inside of that level the high probability order block that forms. See how we are finding support in the premium end of that order block, and we also have that high probability inversion fair value gap also. Note the bodies again failing to close any deeper into it, and then we see it reprice higher. Note the inversion gap that we see at the 50 DRT level. We find support here, and then the order block that also nests inside of that 50 DRT level. We find support here, again as it reprices higher to an extreme premium. Once we've seen price reprice to an extreme premium, we ideally want to see it look to reprice to an extreme discount, because the market in a consolidated market will reprice from premium to discount, from discount to premium, from extreme premium to extreme discount. Now, let me bring back our DRT levels. And I'm gonna, again, push this chart to the left a little bit more. And then I'm gonna dim them out so that we can see how we have a new dealing range over here. Again, we raided buy side liquidity above the market, and then sell side liquidity below this swing low. Again, forming a new minor dealing range inside of our parent dealing range. We see the market reprice higher into a fair value gap. Again, now we have another fair value gap at that 50 DRT level. This is a reclaimed fair value gap. And then we see the market drop lower back below that minor dealing range low and into an extreme discount. Notice here how we're leaving a high in an extreme premium and a low in an extreme discount. This is extremely typical of a type 3 dealing range inside of a consolidation market. And the reason this is done is to engineer liquidity on both sides of the market before price will run higher into an extreme premium. And then later it will run lower for the extreme discount, but we'll get into that in a second. First, I want to again bring your attention to a new minor dealing range here. Again, same principle. We have rated buy side, we've rated sell side, and now we have this dealing range. That is a minor dealing range inside of the parent dealing range. Again, notice here, it leaves relative equal highs, especially the bodies. So again, we can class this as a type 2 reversal dealing range after price has already entered into an extreme discount from an extreme premium. That's very key. Again, same thing here. Note where we have our high probability inversion fair value gap. It comes at that 25 DRT level. Again, what do we have at that 50 DRT level? We have another high probability inversion fair value gap, and note the bodies. They're stopping dead at that 50 DRT level, and it's also leaving the discount portion of that fair value gap open. And then we see this huge displacement through the 75 DRT level inside of this minor dealing range. Again, this is great news. This is what we want to see. And then we find support here, sending the market back into an extreme premium. Note what happens next. It starts consolidating inside of an extreme premium, engineering relative equal highs. So smart money are accumulating short positions here, and they're going to distribute these shorts to the willing sellers below the market inside of an extreme discount and the major sell side liquidity pool below the initial dealing range low. Now that this event has occurred, we have seen a major sell side liquidity pool raided below an old dealing range low. Again, remember, this is a parent dealing range. How low can it go below that dealing range low? Well, there are various ways of interpreting that, but one of the easiest ways is that we can take one of these grades and project one of those quadrants lower. In this case, we can see that the bodies of the candles here are failing to close below that deviation. Furthermore, we also have equal highs above the market. So what does that become? It becomes a type 2 dealing range. So now we have equal highs above the market after raiding a major pool of sell side liquidity below a parent dealing range low, and we're seeing all of this consolidation. Now we have a clear draw on liquidity above the market, and we see the market reprice higher using all of that liquidity below the parent dealing range low as they're accumulating that over here and offsetting all of those accumulated longs to all that buy side liquidity above the equal highs and the high of the parent dealing range. Now, I want to take your attention to this little piece of price action over here. And what we're going to do is zoom in onto the 4-hour time frame. You can see here that we have the old dealing range high and we have that 75 daily DRT level. Note how price displaces through that dealing range high. We come back higher into an order block and fully rebalance that area and then drop lower into our 75 DRT level. Does price close below it? It doesn't. We then see the market turn around and then drop into a balanced price range. Since we've had sell side delivery here, buy side delivery through that range, and then sell side delivery back through that whole range, raiding all those lows and into our 25 DRT level. Again, note the bodies. You should now start seeing the recurring theme in price action, whether it's on a higher time frame or a lower time frame, it's all the same. What can you notice above the market? We have relative equal highs up here, and that is going to be a type 2 dealing range. So again, this gives us now a directional bias to run higher. Note how we turn around here and close back through that 50 DRT level. Where do we find support? What are the bodies doing? They're failing to close back below that 50 DRT level. Again, this is feedback that we want to see. Now we have this swing low. Price has displaced and left the fair value gap through our old dealing range high, displaced and left another fair value gap through our 75 DRT level inside of this minor dealing range, giving us a new minor dealing range where we have the swing low here that's nested at that 50 DRT level and the newly formed swing high here. Where does the high probability order block form? Right here inside of that lower quadrant between the 25 DRT and the dealing range low. And note how we find support inside of that fair value gap. Now I'm going to get rid of that and we're going to drop down again into an hourly time frame. Now over here you can already see that we have a new dealing range, and inside of this dealing range we have equal highs above the market, which we can classify again as another type 2 dealing range that sits below a 4-hour higher time frame type 2 dealing range. So this is going to be a very strong draw on liquidity because we have a lot of buy side liquidity resting above the market. So price is going to draw towards these areas like a magnet. Also note, when we turned around over here, we closed leaving a fair value gap above that 50 DRT level. And then when we dropped to the 1-hour time frame, I was waiting for a new dealing range to form. In this case, I was looking for a type 1 continuation dealing range where we rated sell side here and we've rated buy side above the market, marking a new dealing range high and a new dealing range low. Once price dropped into the 50 DRT level from the higher time frame, we see how price really ran higher, breaking structure above this high and forming this new swing high. I then anticipated price to drop lower, back below equilibrium, and I noticed that we had this balanced price range that overlapped with that 25 DRT level. I took an entry over here at that 25 DRT level. My stop was below the dealing range low, and I was targeting the hourly type 2 dealing range high. Notice I got out above that high. Now, I didn't need it to go to the type 2 4-hour dealing range high because this was a low, easy objective for me, and as you can see, the risk to reward on this trade was very nice. Now, I gave the draw on liquidity in my previous video here on YouTube before I even took this trade, and walked through this trade on my Twitter account. But you can do this too. Once you understand the framework of dealing range theory and how we can anticipate the different types of dealing range and how they impact price, and how the DRT levels is the algorithmic market structure where we can find high probability setups, it gives you an X-ray view of how the markets actually book. As you can see, price isn't random. It's not buying and selling pressure. There are very specific things that repeat in price because it's algorithmically coded this way. Understanding dealing range theory allows you to filter out low quality setups and helps you to identify where high probability PD arrays will form, as well as directional bias. This is the highest form of ICT in the simplest manner. So take your time to back test this and you will be amazed with how accurate it actually is. So until next time, I hope you found this one insightful, and I'll see you in the next video.